Okay, champs, welcome back to Libertas Trading and welcome to the UK Labour Print preview for the 11th of November 2025, coming out at 7 in the morning UK time. So, quite an interesting one today, actually. Firstly, we've had some nice sort of medium term moves that have lasted, over an hour for UK Labour data recently. So, it is something that I'm looking at getting into a bit more longer term, which means the profits could be really nice because we usually get really good entries on this one as well. So, quite an exciting print. Also, in terms of rate pricing, we've got about 14 and a half basis points of cuts priced in for December 18th meeting, which is, just below 60% of a cut. That basically means if we get a really hot print, that could push that below 50%. And if we get a really, really weak print, that could push that to sort of a 75% chance of cut. So, I would rather trade the pound lower. As everyone knows, I'm not a pound bull by any means at the moment. But I would trade it, sort of for an hour, hour and a half, 2 hours if we get a good enough print. So quite an interesting one here, and I think some good scope for moves either way. So let's just have a little look at the state of the UK economy at the moment. So just head into the monetary policy report from last Thursday just to get a quick overview. I know we all know the state of the UK economy, but let's just quickly have a little roundup. This will be the same for UK GDP data on Thursday as well. So we've got inflation that's looking really sticky. We've got service inflation that's way too high. It's forecasted to come down a bit. This is the Bank of England's forecast for the next sort of 6 months, and as you can see here, they're not expecting much difference in the inflation print. So really sticky inflation. Head into wage growth, which is obviously a really important component in the UK of inflation due to the old wage price spiral. Get paid more, spend more, prices go up. It's pretty simple. We can see here that wages have been coming down slowly and they are forecast to come down a bit further, but it's really not quick enough for the Bank of England's liking, to be fair. Then we've got GDP growth, which basically here since the last budget in spring has been on a bit of a downward trajectory and it's not looking great. It's looking underlying GDP growth's looking extremely stagnant, and it's that they're looking at for it to improve a bit, but really nothing special. So GDPs and growth is a big worry for the UK at the moment. Just look at some survey data. So business investment intentions are looking dismal as well. So, another massive worry for the Bank of England. And then just heading down to the labour market, we've got a really high unemployment rate, the highest since sort of 2021 levels, which we'll get to soon. And it's forecasted to go higher. So, the labour market's not looking good. We've got sticky inflation. We've got weak growth. We've got an autumn budget coming up in a few weeks, which is expected to be dismal and really bad news. So we're in a bit of a tricky place for the Bank of England and for the UK economy, which is why I would rather sell the pound. But a strong labour print would give a lot of relief to markets and especially to Keir Starmer and Reeves. So, could be really nice trading this either way. So let's have a little look at the tradable scenarios. So, a couple of nuances here. First of all, due to the ONS, the Office of National Statistics, basically being an absolute mess around, we'll just keep it at that. We can't trust these three data prints coming out. So, these would usually be, or especially the unemployment rate and the employment change, would usually be the two most important metrics for this print. But due to ONS methodology changes, due to their own admission, these data points can't be trusted and should be taken with a pinch of salt. So it's a really confusing one. There's a lot of metrics here. They've all got sort of their own little highlights. They've all got their own little challenges as well. But we just need to be really careful on looking at the employment change. And what I'll do is I'll go through the last sort of 3 or 4 months of data prints just to show you how markets have reacted to certain data prints, just to sort of get a hang of, what we're focusing on. So for the claimant count, we don't have any expectations for that. We've got a 25k prior. So, anything lower is better and then anything higher is better. So this is how many people are claiming for benefits. In terms of the unemployment rate, again, can't really be trusted, but we've got an inline outcome of 4.9%. So for a dovish reaction, we've been looking at 5% or higher, which would be on the max of expectations. It would be at May 2021 levels, which is massive, and it would also be a 5 handle. Also, we've had the Bank of England forecast 5% for the end of 2025. So to hit that in September, so this will be September's data, with the unemployment rate expected to worsen into year end is not ideal. So basically, if we hit 5%, we're at 2021 levels, and we're also at the Bank of England's end of year forecast, and we've still got another 4 months to go with the labour market expected to worsen. So, that would be really bad news. And then for a hawkish reaction, we'd be looking at 4.7% or lower, which would be below the minimum and starts to show a move in the right direction after the last month's 4.8% print. So for the employment change, we haven't actually had any estimates for this yet, so I will update this as soon as that comes through. For the average earnings, we'll be looking at 4.7% or lower, which would be a nice drop from last month, in line with the minimum expectations and a move in the right direction for the Bank of England. You know, wages are a massive worry for the Bank of England. And then on a hawkish reaction, we'll be looking at 5.1% or higher, which is back at April levels. It's love prior. I was meant to say above the prior. I'll quickly change that now. Sorry about this. Typos, not very professional. It's in line with the max expectations and should show 4 months and would show 4 months of wage growth on the SPIM. So just a little highlight for the wage earnings, you know, this would show a stagflationary print. So the Bank of England don't want to see wages higher. So there is a small chance that this number is discounted as a negative for the pound. I don't think it'll be an issue because, you know, wages aren't the most important metric. We've got so many things coming in together today. So something to be mindful of. I would still say that the pound trades higher on high wages, but there is a chance if they come in at like, you know, 5.4% and this one comes in at like 5.1% or something, that could be a bit of a worry for the Bank of England and for the market. So we sort of want a sort of a higher print, but not too high, if that makes sense. So for the average earnings ex bonus, we're looking at 4.5% or lower, which would be below the prior, below the minimum, and also back at 2022 levels, which shows 7 months of wage declines, which would be really promising. And then for a hawkish print, we'd be looking at 4.8% or higher, which would be above the prior, in line with the max expectations and the first rise of wages in 7 months. Again, may get some stagflation worries, but nothing that I'll be too worried about unless we start printing like 5.4 and 5.1%, just for example. So we've then got private sector wages, which haven't really been in, we'll talk about this soon, but hasn't really been in the market sort of limelight recently. But we'd be looking at 4.2% or lower, which would be back at Q4 2021 levels, and it would show continued deceleration in private sector wages, which should pressure public wages, which we'll talk about. And then for a higher print, we'd be looking at 4.7% or higher, which would be back at July numbers and show a move in the wrong direction for the Bank of England. And then for the HMRC payrolls, which has taken quite a shine in the last few months. So we're just looking for another negative print, which would be bearish the pound. The bigger the contraction, the better. So if we get like a minus 20k and minus 30k in HMRC payrolls, I think that could be quite good for selling the pound. And then on a positive print for a hawkish reaction, we'd be looking at something positive, would be good, but ideally a number 35k or higher, which would put us back to April levels. So just a quick mention on this. Again, we're not looking for every single thing to come in here and every single thing to come in here. We're looking at the things on aggregate. So the most important metrics I'll be looking at for tomorrow will be the HMRC payrolls, the private sector wages, followed by the public sector wages, followed by these numbers, which are still important, but we just can't trust them at the moment. So it's one of those things where we want everything to come in line, but let's say everything comes in line and the employment change comes in lower. So everything comes in hawkish, but the employment change comes in lower, it's still worth a trade. It's a really tricky one. So what we're going to do now is we'll go through some past reactions and you can start to sort of understand how markets react to different prints, because we've had very different prints the last few months on this one. It is a bit of a tricky one to trade, lots of nuances, but if we get the right move, it can be a really nice one, a really nice profit one. So for all these examples, we'll stick to the euro pound on the 1 minute chart, nice and easy. So just quickly here, we are looking at the public sector and the private sector comparisons. So as you can see here, so the private sector is this white line, and that's the one we're really focused on tomorrow, or one of the ones we're focused on tomorrow. So as you can see here, that's normally a leading indicator for the public sector. So when this starts to rise, this starts to rise. When it starts to fall, a few months later, the public sector starts to fall. And again, when it started to rise July 2024, we had the public sector rise a few months later. Now, what was really promising for markets last month, which I'll highlight in a second, is this private sector came in lower, and that should be a precursor of a public sector pay. So if this does come in lower again, it could be really important. So we can see from this print here, we had employment change coming below the minimum. We had unemployment rate coming lower. We had claimant count coming lower. We had earnings coming higher, but then we had the payrolls change coming lower again. And we had the private sector pays coming again. So, you know, on aggregate, even though we had slightly higher wages, you know, this was a pretty negative print for the pound. And as you can see here, We had a really nice move in the euro pound. I think it only lasted about an hour and a half, but still quite a nice print. So just looking at the month prior to that. So this was in August. Again, we had another mixed print. So we had the claimant count coming in better. We had an unemployment rate flat. We had this employment change coming in really high at 238K. But then we had earnings a little lower. We had the private earnings a little bit lower, but then we had the payrolls change with a higher revision, but then another lower print. So although this was higher than previous, it's still minus 8K of jobs lost on the payrolls. So, you know, not ideal by any means. But the pound did strengthen in this one. So on aggregate, you know, this data was better. You know, not by much, but we still got quite a nice move on this one. So again, we're just looking at the data on aggregate. This was a bad example. This was nothing I would have traded, but yeah, it was still sort of caused a slightly nice move. So I actually traded this one and I got a 2 pip fill, which was unbelievable. So I actually got filled above the start price. So we're expecting downward price action on this one, and I got filled up here somewhere. So it was an absolute dream. But just looking at the data, again, it was pretty mixed. So we had the claimant count coming in higher. We had the unemployment rate coming in higher, which is bad. We had the employment change, which came in higher. We had earnings coming higher. We had payrolls change coming really low. But the big one on this one, so this is where it's worth looking at revisions, is the month before this, we had 109K job losses on the payrolls change, which was then revised to 25K. So we had an 84K positive revision on the month prior. So although looking at this, we had minus 41K on the payrolls change, we had private payrolls growth coming in lower, we had unemployment rate coming in higher, this was still a positive print for the pound because we had such a big revision on the payrolls change. So again, like UK labour data can be a really nice move, but you need to take your time, take a seat, take a deep breath, and literally just look at every print and try and understand how each print is going to affect the market. Even if it takes you sort of a minute to digest the data, it's better than rushing in and making a mistake. So just on this one, if we go to the 5-second chart to see how we reacted, you can even see how it took the markets a bit of time to digest the data. You know, the algorithms got in nice and early, and then market participants thought, wait a minute, that's a massive revision. That's actually good for the pound. And then price started falling. So really important, be patient, take your time. There's no rush. You know, you can get some really good fills on this data, but also price does move slowly. So literally it's always worth taking your time and making sure you do things properly, making sure you check out the revisions, making sure you check out all the prints and trying to understand how each one impacts the markets. So go into the last print now. This one's from June. And again, another nuanced print. I'm sorry to confuse you here, but this just really shows how mixed UK jobs data can be. So you can see here, we had a massive miss on the HMR payrolls change. We had all three wage metrics coming lower. We had the unemployment rate flat. We had the claimant count coming higher, which is obviously bad for the pound. But then we had this employment change coming above the max. But as we know, we can't trust the employment change at the moment. So sorry about that. I had a knock at the door, so I lost where I was. So yeah, basically really bad print. The employment change coming really good, but we can't trust this data. So look at the pound's reaction. We got a really nice fill, and then we just moved on for ages. So again, we can get some really sort of some mixed prints, but you know, you just need to sort of understand the general consensus on aggregate. How is this going to move the markets? Take your time. There's no rush. So what we're looking at trading here. So for once, I'm actually looking for a medium-term play on this one. So for a dovish reaction, we can look at some pound Aussie downside. So the Aussie solid today with risk on due to government shutdown looking like it's coming to an end. We've got the Aussie dollar, which has been struggling on some positive catalysts as of late, but it looks to be largely risk driven. So we've had a break and retest of the 203 level, which looks prime for more downside. So just quickly looking at the pound Aussie chart. So yeah, we've had this resistance level, turn support. We broke it, we've retested it, and now we can move lower again. Probably targeting 196 would be quite a nice level. I mean, we'd have that 2 psychological level to break first, but if we can break that tomorrow, 196 could be a nice little target. Also, we could look at some euro pound upside. So it's the purest rate differential play right now with so little going on with the euro and the pair always sensitive to UK data. Momentum looks nice, although it looks like we're struggling a bit at 88p. So quickly looking at euro pound, this is sort of my most, like the purest pound growth differential play. So this is always like the sort of safest bet to go with, especially at the moment. The euro's being so boring right now. So, you know, it's quite a nice one, nothing exciting, but a nice steady mover. So quickly looking at the euro pound chart. Again, we've broke through this resistance, which was pretty tough. We've came down, tested it, pushed higher again, and we're sort of stuck around this 88 pence level. So it would be quite nice to see that push higher and maybe target that sort of 88.75, which is quite a big psychological level on the euro pound. So looking for upside on this to continue the momentum. So for a hawkish reaction, we can look some pound yen upside. So there's not much I want to buy against the pound right now. I would want to buy the pound against right now. But with risk on sentiment in markets and pretty hawkish stuff from Japan's PM last night, where she's very much flexing her authority over the Bank of Japan. So recently I've been a bit more dovish on, I'll be a bit more hawkish on the Japanese yen because her messages haven't really made markets react much. But after last night's comments where she was pretty dovish, and she basically said that we're in control of monetary policy. That's basically what she said last night. So yeah, pound yen could look nice if both of these rhetorics continue into the morning session. There's also more worry of jawboning from the Bank of Japan or from the Japanese officials over yen intervention if we approach 155. But we didn't have any comments last night that I saw. And yeah, until we start moving higher in the dollar yen, I can't imagine that being too much of an issue. So just looking at the pound yen chart quickly. So yeah, technically pound yen looks quite nice. We've had this major support level, major resistance level here at 200. We've retested it 1, 2, 3, 4 times, and we're now breaking higher. So, you know, pound yen to the upside could look quite nice if we keep getting more dovish comments from Japan's PM and we get some more risk on sentiment. And then again, euro pound downside, a very good rates play, especially when nothing's happened with the euro, but you will be trading against momentum on this one. So that's just more of a safe play there. And then for a scalping play, depending on how euro US dollar is trading in the morning before the data release, it usually pays to enter as soon as you can, but because we've got so much data coming out, please take your time to process it. So I'll be looking at a 5 pip target on euro pound and a 7 pip target on pound dollar. So my play tomorrow morning will be to take half off the table after a few minutes and hopefully with some nice profits guaranteed, move stops close to break even and then let the price run for 90 minutes or so depending on the severity of the deviation. Another quick thing to note is really keep an eye on how price action is after 30 minutes when the Bank of England pricing opens up. So I'll quickly show you an example now because this can be a really nice play. So we basically get Bank of England pricing open up at 7:30 UK time. So this is when markets basically see how much this data has impacted the rates pricing. So what you tend to see is at 7:30 on the dot, you usually get a candle on the 1 minute chart which pushes higher. And that can, if the data is good enough, can cause a trend which lasts up to an hour. So just say you scout this data, you're in and out, you've closed your trades. You can wait till 7:30. You can wait for that 1 minute candle. You can put stops a couple of pips below and just ride the trend. So this doesn't happen all the time, but it's just really nice to watch. So 7:30, wait to see the reaction on that 1 minute candle and then just ride the price. We'll look at another example now. So this was October's print. We've got 7:30 here. So the 7:30 candle wasn't amazing, but at 7:31, we had that massive move higher on the 1 minute candle. We could have put stops just below here and then just ride the move for an hour or so. And then looking at another example, this is going back to 2024 in December, but you can see we had a real nice move lower in the pound and then 7:30 on the 1 minute chart. We had a push lower on the dot. You could have put stops up around here somewhere and then price move lower sort of for the next hour, hour and a half. So a nice little play, nice little tactical play. You can keep your risk nice and low. You can maybe risk some profits we made on this move. And yeah, it's just always a good little, for me, it's quite a low risk play and it pays off most of the time. So something to be mindful of. Anyway, guys, that's the preview for UK jobs. Good luck. Any feedback, give me a shout. If you want to like and restack this, that'll be really appreciated. And yeah, good luck. Hope we can make some money.